Hey, happy Wednesday to everybody here. My name is Brent Moores, and time for managing your options portfolio. This week, we're going to go through, of course, what we do every week in this class in terms of we're going to look at different options positions and discuss the management of those options positions. But we'll also hit some other topics as well, which we'll get to in just a minute. Glad you're here. I see some familiar names in the chat. Thank you for joining me. And thanks to Connie. Connie's helping me out in the chat. I appreciate Connie. You can follow Connie or myself on X at Connie Hill CS, at Brent Moores CS for additional content throughout the week. Now, before we get too far into this material, though, I do need to remind you that options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and rolling strategies can entail additional transaction costs. The material today is intended for general informational purposes only. Paper Money software application is provided for educational purposes only as well. Paper Money does not assign short options early. That's different than your real account. And let's see, for the sake of simplicity, I'm not going to factor in commissions or fees on example trades we place, but just realize they are something to pay attention to. Past performance is no guarantee of future results. All investing involves risk, including the loss of principal. And Schwab does not recommend the use of technical analysis as the sole means of investment research. Okay, let's head on over to the Thinkorswim desktop software platform. Here's the S&P 500 just cruising up above 7,000 today at its high. That's an all-time high on the S&P 500. So strength is continuing, and maybe that'll change at some point. But right now, for trend traders, the thought is the trend is continuing up. And that's an approach that people take to the market. Very often they'll say, hey, something has been strong, whether it's the market or sector or industry, and they'll say, hey, we think that that's going to continue. Kind of a relative strength approach to the market. In fact, some people will take an approach to the market. What we do is we call it a top-down analysis. In other words, we look at those areas, those broader areas that have strength in the market, like a sector that's doing well. And then only after we identify that sector, then we kind of narrow in and say, I want to look at the stocks that are in that sector for potential trades. Or you can do the same thing on the bearish side. You can look for a weaker stock or industry group. And if you're looking for a bearish trade, maybe those are the fishing grounds, so to speak, that you take as you look for those. So there's different ways to do it. One way is to just use your watch list. Of course, you can do this on the Market Watch tab if you like. Go to the quotes page and you can do it this way. And here, maybe there's different return columns you use, but you don't have to. You can also just use, excuse me, you can go over here and you can pull up and you can see how various sectors are doing by clicking over on your watch list. This is a public watch list, by the way. If you just go to public, S&P sector indices, that's for sectors. And then this one that says S&P 500 sectors and industries are kind of similar. The top one is your sectors. The second one breaks it down further. But if we do that, and let me get out of that, and we have this, then we can add in columns to sort what we want. Now, I added a description column so we can see what they are, because otherwise, if you just look at the symbol, you're probably not going to be able to make head or tails of the symbols there. But if you add the description in there, what you can do is you can look and you can see, oh, here we go. There's the different sectors, and we can see how they're doing. This is a today's performance, and this is a month performance. You can add these columns or any other columns that you want here. You click on the gear. You see that little gear there? You click on that, click on customize. You can go to percentage change. That gives you today's, or percentage change since. And then when you add that, it gives you the choice of different time frames right there. different time frames right there. And so I just selected 1 month. So we're just looking at the last month return here. Let me just make this a little bit bigger so you can see it. There we go. And here's the last month's return. And I can see, hey, this is sorted this way. You can sort it high to low if you want. There we go. Energy's been doing great. Materials been doing great. Financials, healthcare, not so much. Now, of course, this is one way to identify these, but you may decide that you see something in the market that's stronger, and you can obviously do it that way. If we do the same thing and just change this from sectors and indices to sectors and industries, in other words, we can break it down to all the subsectors here and look at it that way. And then again, you can sort good to bad, and you can see, oh, hey, look, we got gold right up there. Now, let's say this is something you say, hey, look, I want to take advantage of gold. I know many of you are aware of gold, and maybe you may even look at the symbol, GC, okay, /GC. This is a future symbol. We're not going to trade futures today. I'm just looking at the price of gold with this, and you can see, hey, this has been taking off. Maybe you want to avoid it for that reason, maybe not, but some traders that want to invest into strength may still be interested in this, but they don't want to trade futures. Do you have some recourse? Is there a way to do this? Well, yeah, there's other ways to do it. You could trade ETFs, which I'm not going to get into today, or mutual funds, which I'm not going to get into today, but you can look for individual stocks in these groups. So you're not stuck to trading futures if you don't want to trade futures. And we're not going to trade futures today. But let me kind of give you an approach to how you may consider this. One thing is, let me just get rid of this left-hand column, and you can go to the scan tab. And you can just create a scan. I'm going to just remove my filters here on this scan. So we're going to start from scratch on their scan. And I'm going to go, instead of scanning all stocks, I want something that may be optionable. So I'm going to just go to public, and I'm going to start with the S&P 500. And I'm sticking with the S&P 500 here because gold is pretty specific as to what we're going to be looking at. And if I narrow it down too much, we may not get any stocks that actually fit the bill here. So I'm leaving it nice and broad, S&P 500. And then how do I narrow it down to gold? Well, what I can do is then intersect with and go to by industry. Now, look, if I wanted to narrow it down to real estate or utilities or community, whatever, you can pick it. These are the main sectors, but I can also go and narrow it down by going to materials and go to metals and mining. And if I want to just click on that, I can do all metals and mining, or I could break it down, and I'm going to look at gold here. So I'm going to click on gold, and we're just going to click and see if we got one on there on the list. Okay, so it's a very specific group, so we don't have this, but in general, you're going to see a high correlation, I think, between a gold miner and the price of gold. In fact, let's look at that chart for Newmont Mining. Okay, and this is not a suggestion, but this is an example. And you can see Newmont Mining has taken off very strongly, and perhaps we want to add a trade on this to our options portfolio. Now, in this case, I'm going to go with the idea that we're going to go into strength. So I'm going to go with a bullish trade here, knowing full well this could change at any moment. But I also want to hedge my bets a little bit, in a sense that if it's been going up strong, it could fall pretty quickly too. So I'm going to do a spread trade here to try and limit my risk on this. And I'm going to keep it simple. I'm just going to do a short put vertical spread on this. So I'm going to go to trade. I'm going to go to my stock, which is Newmont Mining. Okay, there's Newmont. And one thing you may want to check out is earnings. When is earnings? Let's go to the Analyze tab. earnings, Newmont, February 19th. Now, you don't need to necessarily avoid earnings, but you should be aware of it. And in this case, I probably am going to look to exit before earnings, but you don't always have to on your trades. But let's do this. Let's go to trade, and let's look at it for a short put vertical. So I'm going to look at the puts, which are on the right side of the page. I'm just going to go out to the 23rd. Now, you'll notice this is a day after earnings, but I'm not going to hold this all the way to expiration. So don't fret. Even though I'm saying I'm going to get out before earnings, and this expiration date is technically a day after earnings, that's okay. One of our main rules that we use in terms of money management on short options trades, short put verticals, short call verticals, just plain old short puts typically, we're going to look to get out with about a week to go before expiration. In this case, I've got 23 days. That's enough time here. 22 days till expiration technically. But so I'm going to look for this, and I'm going to use delta as my guide here as kind of a strike price to pick. Delta, which tells us how much the option is going to move in relationship to a $1 move in the stock price, can also give us an idea, at least, of the probabilities of it going in the money. We don't want it to go in the money, so we want to keep the probabilities down. I'm going to go to a delta of around 33 there. Usually we're looking kind of in the 30 to 35 range in this class. I'm going to click on the bid price, and I'll go down, and I'm going to click on the ask price, control click, and that brings up my short put vertical. By the way, there's a survey link in the chat. We appreciate your feedback, everybody, if you'd fill that out. Here we go. Okay. It's going to put it in at the mid price. Realistically, we're probably not going to get filled exactly at the mid price. So I'm going to move it down a little bit from that mid price. As much as I'd like to get filled at the mid price, probably not going to get filled at the mid price. If I click on confirm and send, I can look at this and I can read this over and see what I got. I can see my max profit, my max loss. Now, I risk more than I possibly gain on this trade, but it is a high probability trade. That's the price you pay, so to speak. And if I want to do more than one contract, I can always change that as well to more than one contract, confirm and send, and I'm going to put this in my short verticals, short verticals category. And so we got that in. Okay. Now, let's go and let's talk about another approach here on this. Let's try more of a bearish approach. How about? So I'm going to go back here, and we're going to look over at, I'm just going to go to my main sectors here. And so we're going to go to public S&P 500 sector indices. And again, here's the last month's returns. And I can see, energy and materials, we just did a trade, materials trade, consumer staples, and so on. But we can go down to the bottom of the list there here and look at financials, okay? Let's look at, financials have been, by quite a ways, actually, the worst performer over the past month here. And furthermore, they have released earnings for a lot of them, at least the big banks have released earnings. And so we won't have to deal with earnings. Well, we'll have to double check each individual stock, but there's a good chance we won't have to deal with earnings on this. But let's look for maybe a bearish trade in the financials category. And for that, what I'm going to do is I'm going to go to scan. I'm going to reset this scan, okay? And we're going to get out of that. And in fact, what I'm going to do is I'm going to add a scan in here. Okay, we're going to do a scan. I'm going to do a pre-existing scan, and I'll share this scan with you if you like. I'm going to load a scan query. I'm just going to go to personal scan, and I'm going to go to just a bear flag scan that I have. Now, When you have the scan, you can then narrow it down further. Notice this scan is just S&P 500. I'm going to click on this next category here because it allows me to do more. And I'm going to go, I want to just do financials. So I'm going to go to by industry and I'm going to go to financials. And I'm not going to break it down. I want all financials. So I'm just going to select all financials. And then what I'm going to do is I can scan. Before I do that, let me just mention something. If you want to avoid earnings, you can add a scan parameter in here to avoid earnings. How do we do that? I'm going to go to add filter. I'm going to go to study. Now, study filters are not available in paper money. They got to be on your real money platform. Study. I'm going to go and it says ADX crossover just because alphabetically ADX is the first on the list. I'm going to change that though. I'm going to go to corporate actions, earnings. I'm going to say earnings, has an earnings. No, I don't want has an. I don't want an earnings announcement. Does not have an earnings announcement anytime. And I'm going to go to the next 20 bars. That'll give me about a month here. And I'm going to scan that. And it comes up. And we got some stocks here. Okay. So here's the stocks that meet the list here. This is stocks that meeting this kind of bearish scan. And I'll share this scan with you. Share scan query. Let me just do this. Bear scan. And by no means don't feel any obligation to that you need to use this, but just in case you want, I'll throw that in the chat here. And I will also add it to the description if you're watching of this webcast, if you're watching on a recording of this, you can find it in the description there after the class. I haven't added it yet. Okay. Anyway, here are our stocks that meet the parameters. So we're looking for something that's kind of bearish. Well, we got Wells Fargo, Citigroup, Bank of America. They shouldn't be having earnings because we added that parameter on there. And you can pull up, any of these. Here's Wells Fargo. Okay, fair enough. Citigroup. Fair enough. There you go. And Bank of America. Okay, so I'm going to take a bearish approach on this. And I'm just going to do the opposite trade we just did before. We did a short put vertical before, which is a bullish trade. We're going to do a short call vertical, which is a bearish trade here. Now, bearish trade, we think the stock's going to go down. If you don't think this is going to go down, then you want to do this trade. Because this is just a sample trade. But I'm going to go here, and I'm going to look to place that bearish trade here on this. So I'm going to go to, instead of Newmont Mining, I'm going to go to Bank of America. I'm going to go out roughly 30 days on this. That's kind of a typical time frame we do on these trades. And the reason is we do this around that 30-day mark, typically, is we're trying to balance time decay on one end. In other words, we want the time decay helps us on this trade. This is a positive theta trade, a short put vertical or a short call vertical, which is what we're doing here. And so if we have too long till expiration, let's say we go out 79 days or 179 days, 107 days, time decay is not going to be as big a factor in that case. So it really starts to ramp up as we get closer to about the month mark. And it ramps up a little bit from there as you get closer to expiration. So that's kind of an advantage of doing that. Going out too short, we can get fairly high thetas typically, but then you don't really have that much time enough days in the trade, and really you're just kind of become more speculative as to what the short-term price movement is. Of course, this still has some speculation as the short-term price movement, but we're giving theta more of a chance to work. So I'm going to go out about 30 days here on this. And I'm going to do the same thing I did on the short put vertical with the short call vertical. I'm going to use delta as kind of an approximation of expiration. So I'm going to go to the 53 strike, and I'm going to sell that 53 strike. I'm just going to click on the bid price on that. And then I'm going to go to the we'll go to the 54 strike, and I'm going to buy the 54 by holding down the control key and clicking on it. Now, alternatively, what I could do instead of doing that is I could change spread to vertical, and I'm going to go to that 53.54, and we're going to look to sell that. One note of caution or a heads up on that: if you use vertical here, you don't use delta as your probability of being in the money or out of the money in that case, because this is the combined delta of these two strikes, the 53 and 54 together. And so that's not what we'd have. So anyway, so you click on that, click on the bid price. We're selling this, and I'm going to let me click on confirm and send. Here we go. Risking $69. That means I'm willing to risk a little bit more on this. We want the stock to stay below the $53 level. If you're looking at the chart and you think, I'm going to draw a quick line here, right around that 53, right about there. If you think the stock's likely to go above that, then you would not do that trade. As long as we're staying below there, the time decay should be assisting us. And we're hoping it's going to stay there, not for months or anything, but for the next, how many days? Roughly month there. Okay. So I'm going to click on confirm and send. Actually, I'm going to go again. Mid price would be nice, probably unlikely. I'll go down to maybe 29 on that. Okay. I'm going to send that. I'm going to put it in our short verticals bucket and put that in. Now, sometimes I get the question on these short verticals: should we put in a stop on these? You don't have to. Sometimes it would be helpful. Okay. In fact, right now on Oracle, this trade, we have a short vertical on. It's not looking so hot, is it? I've got a 180, 185 short put vertical on Oracle. We want the stock to stay above 185. Let's look at Oracle right now. ORCL. And it's not. Now, let me click on my little drawing tool here. I think we got in, we saw a low here, and then we saw a higher low, and we crossed above our 20, and we were thinking, hey, we saw, a breaking above our highs there. We thought, hey, this is looking bullish. Well, you know what? It turned around. It went south on us there. Okay. So, hey, it's going against us. We could get out right now on this. How much time do we have to expiration? Because as I mentioned, when we get, say, below 10 days, maybe a week till expiration, we're looking out, we still have enough time on this. We don't have earnings coming up in the super near future. We just had earnings in mid-December. So it's just a matter. We may decide, hey, look, things are not going well, but I'm going to let it see if this support will hold here. And I'm going to get out if we break down below, we'll say maybe 160. We'll give it a little wiggle room here, about 167. We'll call it quits at that point if it goes there. So if I want to exit this at below 167, I can highlight this I can right click on this. I can create a closing order to buy it back. And I'm going to say market good till canceled. I'm going to click on the gear and I'm going to say, we're going to get out of this if this goes below 167. Now, if you wanted to cut your losses right now and just get out right now, accept your losses, you can get out. By the time it goes below 167, we'll probably have higher losses if it's going to go out. So if you're bearish on this at this point, you may just look to get out of this trade. But we're going to stick with our bullish theme. I'm going to click on save here. We're going to add that stop in there and send that order on that. Okay. Now, we mentioned if you're in a trade, a short put vertical, short call vertical, and you got in the trade because you were bullish to start or bearish to start in the case of a short call vertical, and you look at the chart and you're going, hey, this is great. We thought we were bullish, but this is now just bearish. You just get out of the trade. Okay, that's one reason you would get out of these. If your initial technical analysis, you change your mind on, you go, that's not bearish anymore, you just get out. Okay. Another reason you'd get out is as we approach expiration. So in other words, Walmart, hey, I've got 9 days to go till expiration. Under the 10-day mark, usually we're just going to look to get out of those. I'm just going to right click on this. I'm going to create a closing order. And whether we're doing good or not so good, we're going to look to get out of this trade. And so I'm just going to look to get out of this once we're under the 10-day mark on that. So we're out of that Walmart trade. Now, question in the chat. Ricebird said, hey, on the bearish trade, is this theta still help us? Yes. Short call verticals, short put verticals, if you enter those trades out of the money, the time decay is going to help you. Let's just kind of visualize this for a sec. Let's say we did a short call vertical. A short call vertical, you have a short call. I'm just going to put SC there for that. And we have a long call. Okay. And typically we would do those out of the money. So the stock is going to be down here. I'll just put an X there. Okay. Look, short calls, if it's just a plain short call, is positive theta. Okay. Positive theta. A long call is negative theta. Time decay works against us. I'm just putting TH for theta there. Okay. So do they totally offset each other? The answer is no. Theta is highest typically at the money contracts, or it's higher when you're closer to being at the money. If the stock is here, which is closer to being at the money? The short call. Therefore, this theta, the positive theta, is going to dominate on those. This theta is still going to be relevant, but it is not going to be as dominant. Well, let's say we enter this trade and this stock, which we thought was going to stay down here, actually goes up. If it goes up enough, let's say that stock goes up enough to the point that this one's closer to being at the money, that trade will switch from a positive theta trade to a negative theta trade. So in other words, just casually, I will often say a short call vertical or a short put vertical are positive theta trades. Well, that's not always the case. They are if you enter them out of the money. But over time, they can change if it goes against you far enough from being positive theta to negative theta. So I'm glad you brought that up, Ricebird. Great question there on that. Okay. So essentially, when the stock gets closer to being the long contract and the short contract on those verticals, then your theta is probably going to switch about that point. All right. All right. So let's go and talk about some other trade management here. We talked about some short verticals. I want to hit on a bunch of different categories here, and we'll look on this. Caterpillar. We rolled Caterpillar last week, I think, or maybe it was 2 weeks ago. I was out of this class last week, so I guess it was 2 weeks ago. I've got earnings coming up, I think, tomorrow on Caterpillar. Let's just look. Caterpillar. And yeah, here's our earnings coming up. Am I willing to hold through earnings? Yes, this is intended to be a longer term trade. Now, this trade we have rolled this 3 times now, I think, and this trade has just been our star of the portfolio. It's done really well. This helps to offset some of those losses that we saw on those short vertical trades there. But this one's been doing well. I've got 352 days on this. This is a leaps. Okay, this is a long call, but it's a leaps. In other words, expiration is almost a year on this. If I'm planning on being this for a long time, for the better part of a year, earnings are inevitable, okay, because they come out quarterly. So I'm not going to jump out of this just because earnings are coming up. So we're just going to let that stay put. When would I get out? Well, I'd get out if I turn bearish on it. I'd get out if that'd be the primary reason if I turn bearish. As long as I'm bullish on this, of course, as we get close to expiration, then we'll get out of this. Okay, so thing in the chat, question in the chat or statement in the chat, more leaps, please. I'll try and do more leaps in future sessions here on this. I appreciate the suggestion. I don't have any on. I'm probably not going to do any more today, but we'll look at that. Okay, now, would it make sense to add a stop to this? Probably, right? Probably. So we're going to add a stop to this. So let's look at Caterpillar. So here's Cat. And I'm going to say, look, we have a bounce here on this. I don't want to be too tight on my stop. This is intended to be a little bit of a longer term trade. So even if we have a bad earnings and it goes down here, I'm going to stick with it. But if it goes down far enough, we'll say below this is our 50-day moving average. We'll give it a little wiggle room, maybe 580. We're going to look to get out of this trade. So here's what I'm going to do. I'm going to add that in. I'm going to add in an exit on this. Okay. Some good questions here. I'll try and address those questions there in just 1 sec. Let me just add this in while I got this. Okay. So I'm going to right click. I'm going to create a closing order. We're going to sell this, and I'm going to make this market good till canceled to get out. I'm going to click on my gear, and I'm going to say if it goes below 580, then we'll get out of this. Okay. Save, confirm, and send. Okay. And we'll send that. Okay. So let's address questions, because these are good questions, and I appreciate your questions here. I'll just try and go in order here. Okay. Trader Joe, why wouldn't I add some downside protection? Well, first of all, hopefully that's what I just did on that, is add some. And now that's not guaranteed. Stops aren't guaranteed. Caterpillar could gap down to $400 overnight for all we know. Okay. Could I add a long put in there for protection? I could, absolutely I could, but just keep in mind, if I buy a put on this, I'm adding in more negative theta. It's already a negative theta trade. I'm also adding a cost in that if the stock goes up or goes sideways is going to hurt our gains there. I'm not saying not to do it, just recognize your pros and cons here on this. Okay. So that was a good question, but so, it's something you can consider there. Okay. Eric says, why not lock in the gain and buy again? I could lock in the gain here. I'm not sure that it helps our situation here. Okay. If I lock in this gain here, so that's doing great. We can lock in this gain. But if I immediately buy again, I'm going to be losing on the stock, on the new call option that we just bought in again. I don't know, see how that makes a difference versus just removing some of the gain here that we already have here. Yes, I'd be capturing some gain there, but I'd be spending that money on a brand new trade. Now, we do sometimes lock in gains occasionally on this webcast, usually when our delta gets up high enough. In fact, on Caterpillar, that's exactly what we did. We rolled Caterpillar, okay? If I pull up CAT, here's CAT on this, and I look back at our trade history on this, we rolled this, and in the process of rolling it, we brought in a credit here on this. And that had some pros and cons on this. One of the pros, well, it depends how you view it, we lowered the delta. By selling out and locking in the gain and rolling out, you may take an opportunity to lower the delta, which could help you if the underlying stock drops, we'd be losing money at a slower rate. So it's something we'll consider in the future, but right now, no, I think we're going to keep this Caterpillar trade going. It's intended to be a longer term trade. I don't want to get out of that trade right now there. Now, could I add a collar on this? Well, collars are for stocks, but I could essentially do a collar here of, even though this isn't a stock, it's a LEAPS, by selling a call and buying a put to try and help protect us on the underlying here, okay? However, and Stacy just added this in the chat, you are capping your upside on that if you do. So if you do a collar and Caterpillar has a bad earnings and it goes down, you feel brilliant, right? Hey, I did so great. But if it goes way up, you're capping your upside. So I'm going to stick with what we got here. Okay. Philip Morris, let's move forward. Here's Philip Morris. This is a long call trend trade. As long as we're staying bullish on this, probably okay. We can do this. Let's look at our chart. Are we still bullish on this? Let's see, got a few minutes here. Still bullish, but I may want to add a stop on here. Okay, so that's what I'm going to do on this. I'm going to add a stop. I thought I had a stop on this, but I guess I don't. If I had a stop, I should see a little sell symbol right there on this. So we do have 7 days before earnings. This is one where, hey, look, if I've got earnings and I want to capture my gain in on this, I may want to get out. It's up to you. I can't give you guidance on this because it's just an unknown. We can add a stop in on this. Look, we originally placed the trade at 12 bucks. It's now at 21 bucks. I can move that stop up significantly. My delta's up at 81. So I'm going to move that stop up, or I'm going to add a stop in, and I'm going to put that stop in at roughly 70% of what the current price is. So I'm going to go put in a stop in at about $15. Now, does that guarantee, if I stop in at $15 on the option, does that guarantee a profit on this trade given that we bought at $12? The answer is no, it doesn't. Because look, Philip Morris could have a lousy earnings, gap way down, and it will gap way below our stop. So it's not a guarantee, but it is an approach to try and help us with this trade. So I'm going to right click on this. I'm going to create a closing order. Okay. And I'm going to put a stop in, good till canceled, and we're going to make this at 15 bucks. And confirm and send. And I'm going to send that order. Okay, I love your questions, everybody. You have great questions. Okay, we've got that in there. Again, not guaranteed, but hopefully that helps protect us. Hopefully it helps to capturing any gains if the stock reverses on us, even though it's not guaranteed. Okay, now, could I sell a call against this trade? These are all great questions. I could. It's pros and cons. It's pros and cons. If I sell a call at a higher strike, I'll be limiting future gains on it. I'll be adding in some positive theta, which is helpful. So con is I may be capping my gains. Pro is I'll be adding in some positive theta and bringing in a credit. Okay, those are all great things. So you can do that. I'm not going to right now, but just realize that that is certainly a possibility to do that if you wanted to change this into either a, like, think about it this way. If we were to do a March 20th short call on this, we will have just converted this into a long call vertical, okay? Assuming we did it out of the money, okay, at a higher strike. Or if we did if we didn't do the January 20th date, then it would be a diagonal trade we're converting. We're just changing the trade at that point. So certainly there's no problem changing trades. That's what that would do for us there. Okay. Let me just see if I have. So there's a lot of different scenarios here that you can do on these. Let's go and let's look at some other types of trades here. Okay, so we're going to get a long single options. Let's go down to what do we got here? We got CNP, which is a collar. So this is a collar spread we put on. We have it held through earnings. We got earnings in 16 days. So I'm going to continue to hold this collar. The trade's done well. CNP's done well. We've lost some money on the collar, but that's added some protection here on us and maybe, ease of mind perhaps. I'm going to plan on continuing to hold that through earnings though on Centerpoint there. So that is a collar on that. And I'm not going to get out on earnings on the stock. And we've added some protection in on this. Let's look at Merck. Here's Merck. What is this? I've got a call and put, same strike. One is a long call, one's a short put. That's a synthetic. That's a long stock synthetic. So this kind of mimics the price action, I guess, in a way of the stock. It mimics the risk profile of a stock. It's not the stock. There's an expiration date. We don't get dividends on that. But it's a way that some traders will use to kind of leverage the stock here on this. Okay. I have a stop on it right now. We're up a little bit, not much on this. We didn't get in this very long ago. But this is kind of a leaps synthetic, right? So as long as I'm bullish on this, and I already have a stop in, probably going to stick with this. And I'm going to consider this bullish. We're going to stick with that. And so I'm not going to make any adjustments to that trade right now. All right. So I could look to, move the stop up or something, given that it's done well. But the reality is it's gone up. Where's Merck? Wrong line. Probably it hasn't moved up that significantly on this at this point. Okay, everybody, I'm out of time. Let's talk about what we did real quick. We talked about adding option trades into your portfolio using kind of a top-down analysis approach by looking at stronger industry groups or weaker industry groups and adding bullish or bearish trades to your portfolio. Then we talked about managing. We managed short verticals, long options, including some great questions from you in terms of like hey, can we do this? Can we add in this leg or add a stop here or add in a protective put? Those are all great questions. And hopefully you got the message that there's not often right or wrong necessarily on these, but it's just pros and cons in terms of these extra management techniques that we could potentially use. But anyway, thank you very much for joining me. Coming up next, we've got trading price patterns. Connie, thank you for helping me out in the chat. And there's a survey, everybody. We appreciate if you'd fill out that survey today and give us some feedback on that. And we'll repost that survey there. It's posted at the top. Connie pinned it to the top of the chat there. So we appreciate your feedback, everybody. Everybody have a great rest of the day. We'll see you same time next week. Bye-bye, everybody.